Hello everyone, good morning, good afternoon, good evening, depending upon when you're watching this video lecture. In the earlier session related to the income from other sources, we discussed about some of the specific incomes that will be taxable under this head. Though this head is a residuary head of income, there are certain incomes like dividend, like interest on compensation or enhanced compensation or family pension or casual incomes or incomes from the activity of owning and maintaining resources, etc., etc. So many items are there which are specifically taxable under this head of income. Those items we have discussed in the earlier session. But that is one part of this chapter. Another very important and crucial part of this chapter is gifts related provisions. So those will be definitely asked in the main examination. So one of the most important aspects here, as far as chapter of income from other sources is concerned, will be the provisions related to gift. Of course, our SSC here will be individual or HF who receives a gift. What is a gift? Gift is something that is given by one person to another person, either for no consideration or for inadequate consideration. What happens when a person gives the gift? Nothing happens. For the person who is giving the gift, we are not bothered about him because there is no gift tax in India, that is abolished now. So what happened now is the person who receives the gift will have his gift that has been received taxable under this section 56 to 10, and this table will tell us about what is the taxability of the gifts when an individual or HUF receives them. And gifts could be broadly categorized into three categories. One is money or money equivalents, second one is immobile properties, third one is mobile properties. For money, there cannot be something called inadequate consideration. That doesn't make sense because money can be given just like that. So the concept of inadequate consideration will not arise in the case of money. That will be, if at all given as gift, it will be given without consideration only, naturally. But when somebody receives the money without consideration, when that gift will be taxable in the hands of the recipient. It will be taxable only if that amount exceeds 50,000 rupees. But what will be taxable? Is the amount that is in excess of 50,000? No. No. That is the main point here to note. We are not talking about the taxability of the amount in excess of 50,000. That is not the words used. Whole amount is taxable. The word used is that. Whole amount means the entire amount. Then what is this 50,000? Only a condition. Nothing useful for calculation, only a condition checking. 50,000 rupees is a threshold. If a gift in the form of cash or money is received less than 50,000, nothing is taxable. If it is more than 50,000, entire amount is taxable. Entire amount will be taxable. That is why this 50,000 should never be used for any computational purposes. Only for condition checking, that amount or threshold will be useful. So imagine if a person receives 51,000 gift in a previous year, entire 51,000 becomes taxable in the hands of that person under income from other sources. If he receives 49,900 only, then nothing will be taxable in the hands of that person. Even if he receives 50,000 also, nothing will be taxable if the amount in total exceeds 50,000 rupees. Then the entire such amount of gift, the aggregate of the gift that is received by that person in the form of money shall be taxable in its totality. But again, the point to be noted here is this 50,000 is not a per gift or something like that. Somebody cannot receive 50,000 from X, 50,000 from Y, 50,000 from A, not like that. This 50,000 is not per gift. This 50,000 is per annum for the SSC. So in aggregate for an SSC, if the total amount of gifts in the form of money that he has received during the year exceeds 50,000, automatically that becomes taxable. The entire amount becomes taxable. For example, to understand this, let us say an SSC has received a gift from X around 30,000 rupees. Let us say the same SSC has received gift from Y 25,000 rupees, and he received gift from Z say 15,000 rupees. Each of them individually is not exceeding 50,000. So should we say it is not taxable because gift is not exceeding 50,000? No. No, we cannot say that. So we have to look at the aggregate amount of the gift. Aggregate amount of the gift that the SASI has received is 70,000. That means entire 70,000 becomes taxable. Entire 70,000. That is how the gift provision has to be applied, particularly when the gift is in the form of money. So, if the aggregate amount of the gifts received by an individual or HUF during a previous year exceeds 50,000, then the entire amount of such gift received shall be taxable in the hands of that SASI. That's it. That is about money gift, cash gift, money gift, you can call it. Then gifts probably could be in the form of immovable property also, but the immovable properties can be there given by one person to another person without consideration also, for inadequate consideration also. Once again, if a particular SSE receives immovable property, generally will be what? Land or building. Let us say our SSE has received a building. Okay. Building he has received during the previous year. For the transferor who has given the gift, we should remember section 47, which says that is not even a transfer. Means for the transferor, this transaction of gift is not even a transfer, so it will not have any tax implication for a transferor. But what about transferee who received this building as gift? And here we are talking about without consideration. Just like that, free he has received gift without consideration from somebody else. Then what will be taxable in the hands of the recipient? The stamp duty value of that building will be taxable in the hands of the recipient. Stamp valuation of the property will be taxable. But when, once again, only condition checking, not for calculation purposes, only when, if that stamp duty valuation exceeds 50,000 rupees. If the stamp duty valuation exceeds 50,000, how much is taxable? The entire stamp duty valuation is taxable. That's it. When an immovable property is received by an SSE, who is an individual or HUF, without consideration, just like that, free of cost. So imagine X received a building from Y. X received a building from Y. X is the recipient. Y is the donor. For Y, nothing is taxable because we know as per 47, it is not even a transfer. But for transferee, who is X, it becomes taxable. How much is taxable? Whatever the stamp duty value of that building is, entire amount is taxable. Imagine the stamp duty value of building is 80,000. Entire 80,000 is taxable, not 30,000. So this 50,000 is only for condition checking, not for calculations. Once again, the entire stamp duty value will become taxable in the hands of the recipient of immovable property for no consideration. If is only condition, if that value of stamp duty value of that property exceeds 50,000. That's all. Now another important aspect comes, that is gift in the form of immovable property, but for inadequate consideration. Inadequate consideration means some consideration is received by the transferor, but that is not matching with the stamp duty value. So imagine, let us say X transferred a property to Y. X transferred a property to Y. This is a different example. And the stamp duty value of the property is, let us say, 10 lakhs rupees. This is what? Stamp duty value. But actual consideration for which the X has transferred this property to Y was only 7 lakhs rupees. This is the fact of the case. Okay? Actual consideration is 7 lakhs rupees. Stamp duty value is 10 lakhs rupees. Then question comes, of course, for X there is nothing taxable. Why? Because nothing in the sense as a gift it is not taxable. For X, because stamp duty value is 10 lakhs and actual consideration is 7 lakhs, and we have to apply in that case 50C for X, not as a gift or something. Because stamp duty valuation is more than actual consideration, we have to apply stamp duty valuation for computation of capital gains in the hands of Mr. X as a transferor. So as far as capital gains is concerned, this inadequate consideration thing is not like a gift. Though we call it as a gift here, it is just like transferring an asset, but for consideration lesser than stamp duty valuation or fair market value, as the case may be. Stamp duty valuation is taken for immovable properties, fair market value is taken for movable properties. We'll come to the movable properties later. Let us stick to immovable properties. So for the transferor, what is the treatment? We already know in the chapter of capital gains. 50C will apply. Now what about transferee? Transferee received this. For transferee, what happens is inadequacy. What is inadequacy? The difference between stamp duty value and actual consideration. That is in this case 3 lakhs rupees. Is this inadequacy more than 50,000? Yes. So that's the point here to be noted. If the difference between stamp valuation and consideration, which is in this case 3 lakhs, that we can call this now onwards as inadequacy. That inadequacy, is it exceeding 50,000? Yes. But here that is not enough condition. There is one more condition also there. We have to check this 3 lakhs with two things, not just with one thing. Two things. One is, of course, 50,000. That is standard amount. And there is one more thing, that is 5% of actual consideration. And whichever is higher is what we should compare that with the inadequacy. So what is the 5% of actual consideration? 7 lakhs into 5% means 35,000. Right? Whichever is higher in this, 50,000 is higher. So automatically this 35,000 is useless. 50,000 has exceeded. The inadequacy has exceeded 50,000. So automatically what is taxable? The entire 3 lakhs will be taxable. Once we have checked that, these are not useful for calculation, only for condition checking. Once the inadequacy exceeded the higher of either 50,000 or 5% of the actual consideration, whichever is higher, once this inadequacy exceeded that, then entire inadequacy becomes taxable in the hands of Mr. Y, the recipient. In our case, 3 lakhs rupees will be taxable in the hands of Mr. Y. Simple. Let us take the same example with the same stamp duty valuation of 10 lakhs. Let us say in a different scenario, actual consideration is 9,50,000 only. Not 7 lakhs. Actual consideration is 9,50,000. Stamp duty valuation is 10 lakhs. So what is inadequacy first of all? 50,000. Did it exceed 50,000? No, it is exactly 50,000. So is there anything taxable in the hands of Mr. Y? No, nothing is taxable in the hands of Mr. Y because the inadequacy did not exceed 50,000. Inadequacy should exceed 50,000 in order to be taxable. So let us take another example with the different numbers. X has transferred an immovable property to Y, let us say, with a stamp duty value of say 50 lakhs. But actual consideration is only say 30 lakhs. Then automatically we can easily observe what is 5% of actual consideration. 30 lakhs into 5% means 1,50,000. But what is inadequacy first of all? Inadequacy is 20 lakhs. So this 20 lakhs has to be compared with what? Higher of these two, either 50,000 or 1,50,000, whichever is higher. Of course, 1,50,000 is higher, but still this 20 lakhs is higher than 1,50,000. That means entire 20 lakhs becomes taxable. The entire inadequacy becomes taxable. Now on the other side, let us take another example. Stamp duty valuation 50 lakhs, but actual consideration, let us say, is 48 lakhs. Just as another example. Of course, that means there is an inadequacy of 2 lakhs, right? Stamp duty valuation is 50 lakhs, actual consideration is 48 lakhs. Means inadequacy of 2 lakhs is there. So should we say automatically it is taxable because it is more than 50,000? We cannot jump to conclusion. We have to check first of all 50,000, and the second thing is what? 5% of actual consideration. What is 5% of actual consideration in this case? 48 lakhs into 5% means 2,40,000. Whichever is higher means 2,40,000. Is this inadequacy higher than 2,40,000? No. Which means once again nothing is taxable in the hands of recipient even though the inadequacy is more than 50,000. Since it did not exceed 5% of actual consideration, there is no problem, nothing is taxable in the hands of recipient. So for a 50 lakhs stamp duty valued property sold for 48 lakhs, though there is inadequacy of 2 lakhs, still it is not taxable in the hands of recipient because 2,40,000 was the amount of 5% of actual consideration. Like this, any example can be taken. Imagine if actual consideration is say 47,50,000. Then what? Then also same. First you take 50,000, which is a standard amount. Then 47,50,000 into 5% means 2,37,500. Right? That whichever is higher, 2,37,500 is higher. We have to check that with inadequacy. What is inadequacy here? In this case, inadequacy is 2,50,000. That means in this case, inadequacy has exceeded the 5% of actual consideration, which means the entire 2,50,000 becomes taxable in this case. Why? Because it has exceeded 5% of actual consideration. So for the same stamp duty value, 50 lakhs, if the actual consideration was 47,50,000, then 2,50,000 rupees is taxable in the hands of the recipient. If the actual consideration was 48 lakhs, as we observed just now, nothing was taxable in the hands of recipient. So either full or nil. That is a type of situation, particularly when it is gift. It will not be something like this much taxable, remaining not taxable, not like that. Either it is fully taxable or it is not taxable completely. So that is about immovable property received without or for inadequate consideration. So that is where we have to check 50,000 or 5% of the actual consideration, whichever is higher. Then compare that with the inadequacy, which is nothing but difference between stamp valuation and consideration. If that inadequacy exceeds that higher of these two things, then only the entire amount of inadequacy becomes taxable. Otherwise, nothing becomes taxable in that scenario. That is immovable property transfer for inadequate consideration. Now let us move on to movable property. Movable property could be anything. It could be shares like that, any other movable property. So movable property are not immovable properties. That's all. And what is a property? We'll come to that later. But movable property is understandable. Whichever is not an immovable property, that is automatically a movable property. So all things other than land or buildings are in general considered to be movable property. But for movable property, there will not be stamp valuation. So what should we do? Naturally, instead of taking stamp valuation, we will take the fair market value. Logic is same. Logic is still the same. Here, movable property, if it is transferred by one person to another person for the recipient, if he did not pay anything because he received it without consideration, then the aggregate fair market value of that property will become taxable. Of course, if it exceeds 50,000 rupees. That's it. Fair market value is what we have to take here. If there is a movable property received by an individual or HUF, which has a fair market value of more than 50,000 rupees, then entire amount of such value will become taxable in the hands of recipient. What if the property, which is movable property, received for inadequate consideration? What if in that case? Then we have to look at inadequacy. What is inadequacy? Inadequacy is nothing but the difference between aggregate fair market value and actual consideration. If that inadequacy exceeds 50,000, enough, that entire inadequacy becomes taxable. Here there is no 5% and all. Don't check that 5% here. That was only for immovable property when there is a stamp duty valuation for that. And if the inadequacy exceeds higher of 50,000 or 5% of consideration, then only that was taxable. So this 5% of consideration checking, that point is only applicable to immovable property but not to movable property. For movable property, all that we need to check is what is the difference between fair market value of that asset and actual consideration. Difference between them, we can call that as conveniently inadequacy. If that inadequacy is more than 50,000, then entire amount of such inadequacy becomes taxable. Once again, in all these cases, this 50,000 is not useful for any calculation. It is only a condition checking mechanism, a threshold for taxability of gift, we can say. That's the summary of gifts provision. We have to remember this entire provision carefully because problems will be definitely asked from them. Now, we know this already. We applied that in 43CA also. We applied it in 50C also. Wherever there is a stamp duty valuation different between date of agreement and date of registration, which one has to be taken? Date of agreement can be taken only when provided whole or part of the consideration has been received or paid by way of other than cash, means account to pay check, like that. So banking channels has to be used, account to pay check, draft, bank transfers. With that, any amount should have been paid or received at the date of agreement. Then only the stamp duty valuation on the date of agreement will be valid. Otherwise, we take the stamp duty value on the date of registration for the purpose of computation of taxability of gifts, particularly immovable properties. That is the summary of the gifts provision. Now moving to the very important point once again, because what is taxable, how is it taxable is one part. When the gift is not taxable is also very important, because in these following cases, nothing is taxable. You can say gifts are exempted, but instead of using the word exemption, let us say they are not at all taxable. When? If an individual or HUF receives the gift, any money or property, whatever it may be, from any relative, zero taxability for recipient of the gift. May be surprising, whatever situation it might be. Act is act, provisions are provisions. Reality is that if any gift is received from any relative, nothing is taxable in the hands of the recipient. What happens to that? Nothing happens. Nothing is taxable. Simple. So that is first point. Gift is not taxable if it is received from relative. Also, it is not taxable if it is received on the occasion of the marriage of the individual. Individual here means SASI. Not SASI's children, not SASI's relatives. No. Marriage of the SASI. On the occasion of the marriage of the SASI, if the SASI receives any gift, whatever that might be, that entire amount is not taxable in the hands of that individual SASI on the occasion of marriage, whatever the gifts are received. And any property received under a will or by way of inheritance also not taxable in the hands of recipient. Same way, property which was received and which was actually given by the payer or donor in contemplation of the death of the payer or donor. In other words, the donor or the payer was in the deathbed. On the deathbed, it was the last wish or whatever of the donor that some property should come to one person, the SASI. Then nothing is taxable in the hands of that recipient, because that property was given to him by the donor in contemplation of the death of that donor. Contemplation, not necessarily that the donor really should die. Contemplation means probably almost on the deathbed. From that scenario, if the donor says, I will give this much property to so and so person, the person who has received that will not be liable to pay any tax because it is not taxable gift. Simple. Same way, if any gift is received from any local authority or any trust or any university, that also is not taxable. So very important. Gift will be taxable only in the cases which are other than these payers. So if the gift is received from a relative, not taxable. If it is received from a non-relative, then only it becomes taxable. So we should definitely clearly know and remember when a gift is not taxable. These points have to be very clearly remembered and applied in the problems also. So once again, gifts from relatives, gifts received on the occasion of the marriage of the SASI, gifts received by the SASI under a will or by way of inheritance, gifts received by the SASI in contemplation of the death of the payer or donor, and gifts received from any local authority or trust or university are not taxable in the hands of individual or HUF. Now, one of the important things, actually two important things come here, because we say here money is not to be defined. Money is money, no problem. One point to be defined is property, because earlier also we used the word immovable property, movable property. Immovable property also need not be separately defined, that is land or buildings or both, that is clear. But property means what? Is everything a property? We have to define that the Income Tax Act has done. Also very important point here, other cases are all clear. Other cases, occasion of marriage, we don't have to define marriage. Marriage is marriage. Will, inheritance, legal things, a local authority, trust, university, practical things. So anything other than this first word, all are self-explanatory. But what is who is a relative? That requires a particular definition, very important definition once again. First of all, how gift is taxable we should know. Then when the gift is not taxable we should know. In that, one of the most important things is relative. Then we should know the definition of relative also. This has to be remembered. And let me once again just warn you, this looks very normal, but in the exam, most of the people will look into the roof, trying to remember whether that particular relationship forms part of the definition of relative or not. So don't take it light. It is looking easy to have the memory of this relative, but you have to remember the words exactly and understand the relationships exactly. More than the words anyway are there in English. But relationship, really what does it mean? That you should understand and remember very well. So who are relatives as far as this section is concerned, which means if gift is received from any one of these people, then nothing is taxable in the hands of the recipient. For the payer anyway, there is no tax implication, we already know that. We are only talking about recipient here. So for the recipient also there will not be any tax implication, but you have to understand the other person should be relative. The payer should be relative of the recipient. So not necessarily vice versa. That is where we have to be careful. Always not necessarily that the payer is relative. Maybe the SASI forms part of the definition of the payer. That is not exempt. But if the payer is not the relative of the SASI, that means the gift is received from a non-relative. That means it becomes taxable. So that is why the main application wise, I don't call it confusion. People mix it up and mess it up. So that should not happen. That will happen only if you are not clear with the definition and not remembering the definition. So with the proper memory and understanding of who is the relative, we should never mix these things up. In the examinations, there is a quite possibility for confusion or thinking about whether it is relative or not, having a question mark face. It should not happen. That should not be the case, and that can be achieved only by really remembering all these things and matching something within your brain. So I would suggest actually this entire definition of relative is better for you to understand and remember in your mother tongue. English language is used by law, but more than that, better to be remembered by mother tongue. That will be easier to remember because the relations normally are more remembered by mother tongue. So you can use that as a technique for understanding it. Whichever way you remember, nobody cares. Are you remembering correctly or not? Are you using the provision correctly or not is what matters. But I am giving only a tip. How to remember this definition of relative is easier to understand and remember if you remember the actual relationships in the form of your own mother tongue, whatever it may be. So, who is relative as far as Income Tax Act is concerned in English? One, spouse of the individual. Spouse is, as we know, husband also, wife also, both are possible. Brother or sister of the individual, not cousins, not cousins. We are talking about real brother or sister, the siblings we can call. So, spouse of the individual, brother or sister of the individual, and now the story starts. Brother or sister of the spouse of the individual. So, brother or sister of the spouse of the individual means brother-in-law, sister-in-law also are relative, not ended. Brother or sister of either of the parents of the individual. Again, remember them in your mother tongue, that is easy. Brother or sister of either of the parents of the individual. Either of the parents, mother, father, okay. Mother's brother, mother's sister, father's brother, father's sister. All of them are forming part of this. Brother or sister of either of the parents of the individual is also relative. So what? If we receive gift from them, then that is not taxable. So that is another point in the definition of relative. Of course, the other things are clear. Lineal ascendant or descendant of the individual. Ascendant means the ones who are above the individual, like parents, grandparents, etc. Descendants means the ones who are below the individual in the family tree, like children and grandchildren. Direct, lineal, not side by side line things. No, lineal ascendant or linear descendant of the individual is definitely relative. So grandparents, parents, children, grandchildren will come under that category. Not only that, any lineal ascendant or descendant of the spouse of the individual also. So any lineal ascendant or descendant of the spouse of the individual also. The spouse's parents, spouse's grandparents also will be relatives. Of course, spouse's children, spouse's grandchildren will be his own children also, naturally. So that doesn't matter. Descendant is not a problem. Ascendant, particularly of the spouse, also will be relative. And not only that, the spouses of the persons referred to in items 2 to 6 above are also relatives. Spouses of persons referred to in 2 to 6. Why not 1? Because spouse of the spouse is SC himself, no? Or herself, right? So that doesn't make sense. Spouse of the spouse, the same person will come. So that is why 1 is not required to be included in this point number 7. Other all persons' spouses also are relatives. This is where the major mix-up happens. So first you should remember the other almost 5 points. The spouse is very clear. Other than spouse, just 5 points you have to remember: brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, lineal ascendant, descendant of the individual, lineal ascendant, descendant of the spouse of the individual, and the spouses of all those people who are mentioned in the above points 2 to 6. So that is very important point to apply in the exam questions if such a situation is given. So that can be applied only once you know the original point. First we should know original point, then we should also understand and identify that, okay, this person is a spouse of that original person who was already a relative. Still, that means this person is also a relative, like that. So 7th point is key actually for tricky questions. Remaining things you can remember normally. And of course, in case of HUF, any member of HUF is relative. So for HUF, who is a relative is member of the HUF. That is what relative means. So that is the definition of relative. And if any gift is received, anything like this, from any relative, which is mentioned in this broad definition of relative, and this definition is applicable only here, don't apply this everywhere in the Income Tax Act. Only for this purpose, relative means that. And if any gift is received from these relatives, nothing will be taxable in the hands of the recipient. And we know the other cases also where the gift is not taxable. If the gift is received by way of a will or inheritance, or on the occasion of marriage of the individual, or on the deathbed of or the contemplation of death of the donor, or gift is received from any local authority or trust or university, also nothing will be taxable in the hands of recipient. That is about gift related provisions. Very, very important points to be remembered for solving the problems under this chapter. Now, naturally, another point also becomes important, that is property. What is property? The word is used in many places. What is property? See, property here is not everything. That is where our whims and fancies and our imaginations and creativity should not come to work. What is defined in the income tax? Only for this purpose. Only for this purpose. What is property for this purpose? The following capital assets of the SASI are called as property. So here there is a link between capital gains also. Here, when we look at the word property also. First one is very clear. Immovable property, naturally being land or building or both. Shares and securities are property. Archaeological collections, paintings, jewelry, drawings, sculptures, work of art, bullion. All this list, if you remember, these are all there in the part of the definition of capital assets also. Nothing new here. So these are only the property where there is a gift related provision that is attracted. Imagine if the transfer happens of a stock in trade, let us say, then is that a property? No, it is not a property. That means for the recipient, would that be taxable? No, it would not be taxable. Of course, it will have its own tax implications, because when that property is received, when that stock in trade is received by the recipient, when he sells it, sale proceeds will be taken normally. But because he did not pay anything, he got it free. The cost of that will be zero. So automatically that becomes taxable when that asset is sold later, if that is a stock in trade. So there is now no provision of gift that is applicable if the gift received is a kind of stock in trade, or for that matter any property or any asset which is not falling in these characteristics. Like personal effects are not property, we know that, because those are not capital assets. Jewelry is property, yes. Drawings, paintings, sculptures, work of art, bullion, yes. Archaeological collections, yes. Shares, securities, yes. Immovable property, of course, yes. That is the definition of property. Other than this, if any other gifts are given or received, for giver anyway it is not taxable. For receiver also it is not taxable, because that is not falling under the definition of property. Let us say X gave a motorbike as a gift to Y. Let us say X gave a bike Harley Davidson bike worth 50 lakhs rupees to buy. Why received 50 lakhs rupees worth of gift? Is that taxable? For why? Answer is no. Even though it is 50 lakhs also, 50 crores also, nothing is taxable. Why? WHY? Because it is not a property. It is not falling in the definition of property. Motor vehicles are not falling in the definition of property. So why just receives it and uses it, enjoys it? That's all. Nothing is taxable in the hands of Y. Nothing is taxable in the hands of X also. Why? Because for he is a transferor. For transferor, what is the gift provision? Nothing is there. Only for transferee it should be taxable. But when it will be taxable, provided that the article that is received is property. If it is not a property, then there is nothing that is taxable. That also is another point to be noted. So when is it taxable is the first point. If it is taxable, how much is taxable? That is the second point. And when is it not taxable is the most important point. If the gift that is received is not a property, that is not taxable. If the gift is received from relative, not taxable. And the other list of things where the gift is not taxable have to be clearly remembered and applied in the problems. These are the provisions related to gift in a nutshell. Now let us apply these provisions in some of the problems or exercises or examples, we can say. Exercise number 4. Okay. Mr. A is a dealer in shares, received the following without consideration during the previous year 1920. First of all, he is a dealer in shares. That means shares will be his stock in trade. That we should first identify. And received all these things in the previous year 1920 from his friend, be whoever it is. Friend, not relative. If relative, there is nothing for us to calculate because nothing will be taxable. So because of gifts received from friend, we have to check whether they are taxable or not. Look at one by one. First thing first, cash gift of 75,000 rupees on his anniversary, whatever the occasion may be. If it is not marriage, that will be automatically taxable. Anniversary is not marriage. Marriage anniversary is not marriage. Marriage is marriage. Marriage anniversary is just nothing. Anything else other than marriage of the individual is taxable. So 75,000 definitely will become taxable. So in the main answer, you can say 75,000 cash gift received. Since it has already exceeded 50,000, entire amount 75,000 becomes taxable. Then bullion, fair market value of which was 60,000 was received. Bullion is a property, yes, and is a dealer in shares, so definitely it is not stock in trade. Amount of 60,000 exceeded 50,000, so entire amount is taxable, and that too received occasion of birthday, which is not a exempt occasion. So 60,000 is taxable. Then he received a plot of land at Faridabad. This is immobile property. On 15th July 2019, the stamp value of that was 5 lakhs rupees on that date. And all of these things are without consideration. So there is no inadequacy and all. Even though that property is received without consideration, entire amount of 5 lakhs becomes taxable, naturally, because that is received from his friend. And what is taxable in case of immobile property received without consideration? Stamp duty value. And since it exceeded 50,000, entire amount becomes taxable. So that is the 3 things that he received from his friend, and all 3 were taxable. Now, another thing happened. Mr. A, that is our SASI. We are talking about Mr. A here. A is our SASI. He purchased from his friend C, who is also a dealer in shares, 1,000 shares of X Limited at the rate of 400 rupees each on 19th June. The fair market value on that date was 600, and A sold all these shares in the course of business on 23rd June 2019. So this is a case of gift received, but it is stock in trade because he is a dealer in shares. He received shares means he received stock in trade. Can we call that as property? First of all, no, it is not. That means is there a gift provision applicable? No, it is not. Does it mean nothing is taxable? No, that is also not correct. Why? Because he is a dealer in shares. That means there will be PGBP applicable for him. May not be income from other sources, but PGBP definitely is applicable. He sold all these things. But if at all he is asking only for income from other sources, then nothing is taxable here. And he sold these shares, he said, but we don't know at what price those are sold. We don't know that. So, for understanding purposes, take it as an example. Let us say he received 1,000 shares of whatever company at 400 rupees each. That means he paid 4 lakhs rupees Fair market value of those shares on that date was 6 lakhs rupees. That means there was inadequacy of 2 lakhs. The question was whether that 2 lakhs is taxable as income from other sources. Answer is no. Why? Because the property, the asset that he has received is not even the definition or not even falling under the definition of property, which is stock in trade. That means it is not taxable at all. So that 2 lakhs is not taxable at all. Now the question is, let us say, just for imagination, this is not there in the question, say he has sold in the normal course of business for, let us say, 7 lakhs, right? Then, how much did he purchase for? That 4 lakhs only will be deducted, no? Because that is the real amount of purchased price. So 3 lakhs would be anyway taxable under PGBP. Does it not include the 2 lakhs inadequacy also? Yes, it already includes. So we don't need to separately do any special accounting for stock and trade gifts. If we ignore that, that is enough. Automatically those will be covered in PGBP. If at all those are sold in the ordinary course of business. That was a situation of A purchasing stock and trade from his friend C. It is not a gift, first of all, no. That means no income from other sources. Then on 15th March 2020, he sold this plot of land at Faridabad that he has received from his friend for 7 lakhs. Now the question is, capital gains will be attracted. These two heads are very closely related, as you can observe. So how much capital gains will be there? Naturally, we have to think capital gains point of view now. Full value of consideration is 7 lakhs. Question: what is the cost of acquisition? No indexation anyway. Why? Because he just got this land in July 2019, sold it in March 2020. Less than 24 months for an immovable property is a short-term capital asset, which means no indexation. So what is the cost of acquisition in this case? This is where you have to refer once again. Cost of acquisition under different circumstances. There we referred to gift. If you remember 56 to 10. According to that, if it was already taxable under income from other sources, whatever was already taxed, that will be taken as cost of acquisition. So what was already taxed here? 5 lakhs. That will be taken as cost of acquisition, which means this 2 lakhs will be treated as short-term capital gain. That is the cost of acquisition, 5 lakhs, because it is already taxed under income from other sources head, though the same year, but it is taxable under this head only. You cannot say anyway entire amount 7 lakhs is taxable. Yes, but head of income matters. If the moment we say anything is anyway it is okay, final amount is fine, same, that doesn't make sense. Income Tax Act, particularly the chapter of capital gains, a separate amount has to be known. So 5 lakhs is income from other sources only, 2 lakhs is short-term capital gain only. You cannot say how does it make any difference. End of the day, finally 7 lakhs only is the total income now. No, it makes difference. So you cannot just club them or mix them. 5 lakhs was taxable according to 56 to 10. Why? Because it was a gift. And 2 lakhs is taxable as short-term capital gain. So what is the total income from other sources here now? So 60,000 plus 75,000 plus 5 lakhs. That means 6 lakhs 35,000 rupees is the income from other sources. And short-term capital gain is 2 lakhs. That's it. That was the question. Compute the income of Mr. A under these both heads, chargeable as income from other sources and capital gains is asking. That was question number 4. Then exercise number 5. I think these type of questions we can just easily take those items only which are gifts and which are not gifts. Of course, in the examination you have to follow a proper presentation, particulars, amount, description, etc. Those things should be there in exam. But right now, let us just quickly discuss these things, whether it is taxable or not taxable. Simple. If it is taxable, we'll include it. If it is not taxable, we'll not highlight it. That means only final taxable gift we can find out. Let us look at this exercise number 5. X received the following gifts, all are gifts during the year. Find his taxable gift, he is asking. So gift in cash from brother. In cash from brother. Is brother a relative? Yes. So is it taxable? No, because it is received from relative. 80,000 not taxable. Leave it. Gift in kind from friend. Definitely taxable. In kind means it could be of any immobile property or mobile property. Doesn't matter. Let us say mobile property. Still 70,000 means more than 50,000. So from friend, if it is received, it is taxable. Gift from father-in-law in cash. Father-in-law, you have to first remember what kind of relationship it is. Father-in-law and all is not defined there. We have to understand that. So what is under what category the father-in-law will fall? It is the parents of the lineal ascendant of the spouse. lineal ascendant of the spouse. That is why he is a relative. Hence, nothing is taxable in the hands of recipient. Then, gift from brother of grandfather. Brother of grandfather, is he falling in the definition of relative? No, is not. No. Why? Because it is not there in the definition. Lineal ascendant is there, not the brothers of lineal ascendants. So, it will be taxable. But of course, it will be taxable only if the aggregate amount of cash gift exceeds 50,000, because the earlier 70,000 taxable gift was in kind. That 50,000 is different, cash gift 50,000 is different. Each of the types are having a different 50,000 limit, not full all of them 50,000. For cash gift 50,000 is there, for a gift in kind also 50,000 is there. Gift in kind already crossed, so 70,000 taxable. Whether this 40 will be taxable or not depends upon other things. Looks like there are so many things. Gift from friend in foreign currency 30,000. Yes, now itself it becomes taxable. Why? Because already the total cash gift exceeded 50,000. 40 plus 30, 70. Already more than 50. Friend, foreign currency, whatever it is, doesn't matter. Taxable. Cash gift, that is. Then gift of immovable property from friend, fully taxable, 30 lakhs rupees. Gift from father, golden jewelry set, no, not taxable. Why? Because father is a parent, parent or lineal ascendant means relative. Gift from friend, a golden jewelry set, fully taxable. Jewelry is a property. Gift of color TV from friend, not taxable, even though it is received from friend. Why? Because it is not property. Is color TV a property? Under the definition of property, no. It is a personal effect. It is not taxable because it is not property. So leave it. Gift from neighbor through his will. Will, anything received, not taxable. Will, inheritance, nothing is taxable. So 45 lakhs not taxable. Then gift on the son's marriage, not the SC's marriage, son's marriage. A diamond ring from a non-related person, of course taxable. The marriage should be of the SASI, not of any other member of the family. Then only it is not taxable. Of course, if the son says that he received this, then it would not be taxable in his hands. It's a different story. We don't have to really think about these things from real life point of view. Think about provision and problem, application, answer, enough. Real life, these things are all quite different and complicated. Nobody shows all these things also. Everybody knows that. Those are all very, I would say, unethical things that people do. So it doesn't matter. We cannot get into those things. According to information given, what is the provision applicable, we have to apply and give the answer. To that extent only we have to keep our purview. Then gift from sister-in-law. That is another interesting point. Sister-in-law. Is sister-in-law a relative? Yes. Because sister-in-law could be who? Sister-in-law could be, according to English language, say, brother's wife. Possible, right? Or even sister's wife. Sister's, no, not possible. Brother's wife, let us say, sister-in-law. And brother's wife, let us say, is it falling under the definition of relative? Yes, of course. Falling under the definition or not? Yes. Or even like wife's sister also could be sister-in-law. Yeah, that is another possible relationship. So brother's wife or wife's sister. Both are falling in the definition of relative. Why? Because if brother's wife is there, then spouse of the brother automatically falls under the definition of relative. And spouse's sister is there, then brother and sister of the spouse also falls under the definition of relative. So definitely sister-in-law falls under the definition of relative, which means nothing is taxable from that. So what are the only things which are taxable? 70,000 plus 40,000 plus 30,000 plus 30 lakhs plus 7 lakhs plus 4 lakhs, which means 42 lakhs 40,000 is the final answer for this question. That's all. 42 lakhs 40,000. That was question number 5. Then same way another question can be looked at. This was also a past examination type question. Exercise number 6. A perusal of the Mohan's bank account revealed the following deposits during the financial year 1920. Okay. Let us just identify whether it is taxable or not taxable. Enough. Gift from his friend on 31st December on his birthday, 12,000. As of now, we cannot say it is taxable because it is less amount. So we will wait for it. Dividends from shares of various Indian companies, not taxable, exempt from tax under section 1034. because it did not exceed 10 lakhs rupees. We have to write that note. Gift from the fiancé on 11th February 2020, 85,000. Yes, it is tax. Fiancé is not spouse. Fiancé is maybe in future she or she may be the spouse, but right now no, not spouse. So relationship did not exist when that gift is received from the fiancé, which means entire amount is taxable. Now that it is already 85,000, so gift from the friend also automatically becomes taxable. Already 50,000 crossed. So 85,000, 12,000 both are taxable. Now, gift from his mother's friend. Mother's friend is not relative. On 7th July 2019, on his engagement. Okay, 28,000. Of course, taxable. Engagement is not marriage. Engagement is engagement only. So that is not marriage. So hence it is taxable. It is not exempt. Gift from his sister in Netherlands, exempt, not taxable. Why? Because received from relative. Sister is definitely relative. Interest on bank deposits 40,000 is taxable under income from other sources. The question is income from other sources to be computed. Income on a whole from other sources. Gift will be how much? 12,000 plus 85,000 plus 28,000, total 1,25,000 plus 40,000, total 1,65,000 will be the total income from other sources from this exercise number 6. That's it. Now let us move on to exercise number 7. Once again, discuss. It's not about actually any computation much. Discuss. See, such type of questions can very well be expected. So discuss the taxability or otherwise of the following in the hands of the recipient under 56(2)(10) of the Income Tax Act, which means gift. First question, Akhil HF received 75,000 rupees in cash from the niece of Akhil. Niece of Akhil also clarified here, daughter of Akhil's sister. Daughter of Akhil's sister has gifted 75,000 rupees to Akhil HF. And Akhil is the Karta of the HF. Okay. So first of all, for HF, who is relative? Member of HF is relative. Now the question comes whether the daughter of Akhil's sister will be member of Akhil's HF. No, not possible. Because Akhil's sister is member of Akhil's HF by birth, yes. But daughter of Akhil's sister will be the member of whatever her family, Akhil's sister's family HF, which after marriage will change. Which means the daughter of Akhil's sister is not a member of Akhil's HF. That means niece of Akhil is not a member of Akhil's HF, which means the gift of 75,000 is received by the HF from a person who is not a relative as per definition. Hence, the 75,000 is taxable in the hands of Akhil HUF. Here, the recipient is HUF, not Akhil. So, we have to understand that the gift should have been received from member of HUF. Here, relation and all should not check. Only member of HUF is the only thing. For HUF, who is a relative? Member of HUF. Is niece of Akhil member of Akhil's HUF? No. And that means entire amount is taxable since it exceeded 50,000. Then Nitisha, member of her father's HUF, transferred house property to the HUF without consideration. The stamp duty value of the property is 9 lakhs. Not taxable. Not taxable. Why? Because she is a member of her father's HUF. So, if she transfers a property to the HUF, nothing will be taxable in the hands of HUF because the gift is received from relative who is member of HUF. Next, Mr. Akshat received 100 shares of A Limited from his friend as a gift on the occasion of his 25th marriage anniversary. Fair market value on the date was 100 rupees per share, and he also received jewelry worth 45,000 rupees. Fair market value from his nephew on the same day. So the question comes, nephew will be relative or not for a normal person. So who is the nephew? Nephew will be the son of, let us say, sister. Son of sister. Is it there in the definition of relative? No, it was not there. That is why we have to remember the definition of relative very carefully. In the definition of relative, brother or sister of the SSC is there. Lineal ascendant and descendant of the SSC is there. Lineal ascendant and descendant of the spouse of the SSC is also there. But lineal ascendant or descendant of the brother or sister of the SSC was not there. So nephew will not be considered to be relative from the definition. That definition has to be very clearly remembered. Like this, only questions will come suddenly. We all think that in our personal capacity, in personal lives, these may be considered to be very close people. Doesn't matter. That is not what we are looking at here. We are not having any Saas Bahu serial here. We are talking about law. So what is relative as per income tax law? That only is relative. That's it. No characters required here. No other additional emotions required here. Simply as far as income tax act is concerned, nephew is not. Nephew not means niece also. Nephew and niece are not relatives. That means this 45,000 also is taxable. So this is also a movable property, and 10,000 rupees worth, because 100 shares of 100 rupees each means 10,000 rupees worth shares are also received. Total movable property that is received during the previous year was 45 plus 10,000, 55,000. So what happens here? Entire 55,000 becomes taxable since the aggregate amount of the gift exceeded 50,000. We have to look at aggregate amount. 45,000 individually is less than 50. 10,000 individually is less than 50. But no, for that category, what is that category? Movable property. Three categories are there. Money is one category, immovable property is one category, movable property is one category. For each category, 50,000 limit is fixed by law. So here, movable property total aggregate amount received by Akshat exceeded 50,000, hence entire 55,000 becomes taxable. That is answer for point number 3. Then Kishan HUF gifted a car. See, the moment you see a car, automatically there is no gift at all, because car is not a property. From whom, to whom, by whom, it all doesn't matter. Ultimately, whatever the fair market value, 5 lakhs also, 5 crores also, whatever the car it may be, nothing is taxable in the hands of the recipient. Simple. So that is answer for fourth question. Why? Car is not a property. Occasion, everything doesn't matter. Car is first of all not a property, hence nothing is taxable. That's it. That is exercise number 7. Now, moving on to exercise number 8. Again, theoretical case-based type of questions like this can be also expected. Mr. Hari is a property dealer. He is a property dealer. So what will be stock in trade for him? Property, naturally. He sold a building in the course of his business to his friend Rajesh, who is a dealer in automobile spare parts, for 90 lakhs rupees. So this is the actual consideration on 1/1/2020. When the stamp duty was, valuation was 150 lakhs. That means inadequacy was how much? 60 lakhs. The agreement was, however, entered into on 1/9/2019 when the stamp duty value was 140 lakhs. So now the dilemma. Should we take 150 or 140? For that, we have to check whether on the date of agreement the amount is paid wholly or partly by way of account pay, check, draft, bank transfers, etc. For that, we have to check the further details. Hari received a down payment of 15 lakhs by a crossed check from Rajesh on the date of agreement. Does it make sense? Why? Because crossed check is not enough. Bearer check, crossed check not enough. What the law uses? Only account to pay check, which means this is as good as not a banking channel, which means the stamp duty valuation on the date of agreement cannot be taken for our computation purposes. We have to take only stamp duty valuation on the date of registration. So this is question number 8. What should be taken as stamp duty value? First of all, stamp duty value should be taken as 150 lakhs, not 140 lakhs. So ignore that 140 lakhs first of all. Then what is the actual consideration? Actual consideration is 90 lakhs, which means what is the inadequacy? Inadequacy, let us say, is how much? 60 lakhs. Question is that taxable for the recipient? Who was the recipient? Rajesh. So the question is, discuss the tax implications in the hands of Hari and Rajesh. Assuming that Mr. Hari has purchased the building for 75 lakhs on 12th of July 2018. Would your answer be different if Hari was a share broker instead of a property dealer? We'll come to that later. But first of all, both Hari and Rajesh is asking about tax implications. Whatever this 60 lakhs taxable, for whom? That is for Rajesh. Why? Because he is the recipient of the immovable property for inadequate consideration. Inadequacy is 60 lakhs and it is of course more than 5% of the actual consideration, way too high. So we don't have to worry about that small 50,000 and 5% things. So ultimately, the inadequacy is fully taxable in the hands of Rajesh as income from other sources, 60 lakhs. That is for Rajesh. What about Hari? For Hari is a property dealer. Property dealer sold something and in the course of business. And here what section we have to apply? 43CA we have to apply. When the property dealer is selling immovable property, 43CA, according to that, actual consideration should be what? Stamp valuation. So 150 should be the actual consideration according to 43CA. But he purchased this building for 75 lakhs. That was his original cost of purchase of the building. That means for Hari, PGBP will be there, amount of 75 lakhs. Yeah, that is unfair. But still, that is a law. So finally what? Such kind of transaction should not happen at all. What these people gained? Nothing they gained. If they really had transferred for property worth 150, then Rajesh would not have had any tax liability additionally. And Hari also would not have had any additional PGBP. He would have had PGBP, but exactly the amount will be 150 then, which he would have really received. But now, though he received only 90 lakhs, as per 43CA, we have to take stamp duty valuation only as if it is the sale proceeds. So 150 has to be taken as sale proceeds. From that, his original cost of acquisition was 75. PGBP is 75. That's it. Now the question is, would your answer be different if Hari was a share broker instead of property dealer? See, as far as Rajesh is concerned, it doesn't matter. It doesn't matter for him because for him it is not a stock and trade. He's an automobile dealer. So for Rajesh, it will be still taxable under income from other sources. Entire amount of 60 lakhs will be taxable as income from other sources for Rajesh. No change in that. Only change here for Hari will be what? Instead of 43CA, now 50C will be applicable. Capital gains. Why? Because for him it is not a stock and trade, he is a share broker. And is for him property here is not a stock and trade. That means provision is same, 150 minus 75 will be taxable as short-term capital gain. Why short-term capital gain? Because he purchased it on 12th July 2018 and sold it on 1/1/2020. So 18 to 19, 19 to 20 means within 24 months he has sold it, right? Which means short-term capital gain of 75 lakhs will be there for Hari if he is not a property dealer. So 75 lakhs is guaranteed, whether it is PGBP or short-term capital gain. Only thing is, if it was stock and trade for him, it would be taxable as PGBP under 43CA. If he was not a property dealer, then it would be taxable in the hands of Hari as short-term capital gain as per 50C. For Rajesh, there is no change in the position. Always 60 lakhs rupees would be taxable under income from other sources head. That's it. Very interesting and important type of question. Such questions can be expected in the exam also. Case-based questions. Now let us continue this discussion. Exercise number 9. Some more provisions also needed to be now either applied or known now. So exercise number 9. From the following information, compute income from other sources is asking. Okay, as usual. Particulars, amount. Interest from savings bank account of SBI 16,000. Interest is taxable. Already some people think about deduction is available, deduction is available. We know that. But that is not asked. Na? Deduction is what? 80 TTA, savings bank interest available when? After computing the gross total income of the SASI. We are computing income from other sources. So 16,000 is first taxable under income from other sources. Don't give any 80 TTA deduction and all here. That is why such kind of points will be given so that people misinterpret and mix the provisions from one chapter to another chapter. That chapter 6A deductions are completely different, which have to be given after the computation of gross total income. We are only doing one head of income here. As per the question, we are only required to calculate income from other sources. Where from section 80 comes? Nowhere. So 16,000 is fully taxable without any reference to any other section. Automatically that becomes taxable. 16,000. Next. Winnings of 3 lakhs rupees gross from the state government lottery. Gross already given, so 3 lakhs rupees definitely taxable as casual income. That is also income from other sources. It is taxable. Income from subletting of the house 5,000 rupees per month, which was taken actually for 3,000 rupees per month. Means what? 5,000 rupees is getting income, 3,000 rupees is paying rent. So effectively how much is getting net benefit? That is 2,000 rupees per month. That means 24,000 rupees will be taxable under income from other sources. Subletting is taxable under income from other sources. because SC is not the owner of the property. Then dividend 11,000 is not taxable, exempt. Why? Because it is less than 10 lakhs, exempt under section 1034. Income from owning and maintaining resources 10,000. Of course, taxable under income from other sources only. So that's all. All of them are taxable under income from other sources. What is the total of this? 16,000 plus 3 lakhs plus 24,000 plus 10,000 means 3,50,000 rupees is what? What was asked in the question. Income from other sources. Stop it there. No more ATTTA deductions and all that. That is not the question. What the question asks, that only we have to give the answer. No need to do extra. That will not be giving additional marks, but unnecessarily it will waste our time. So 3,50,000 is the answer for question number 9. Next, question number 10. Particulars of income received by Mrs. Sarita for the year ended 31st March 2020 are as follows. From the above information, compute income from other sources of Mrs. Sarita. Same type of question. Income from other sources we have to compute, applying different provisions of this head of income. Let us take one by one. Family pension received from the government of Madhya Pradesh 15,000 rupees. There we have to apply. Deductions are available under section 57. 15,000, one third of that, or 15,000, whichever is lower. Which is lower in this? 5,000 is lower. One third of 15,000, 5,000 is lower. That means taxable amount of family pension will be 10,000. Deduction we have to take one third of the family pension or 15,000 rupees, whichever is lower. Some people interpret it is 15,000, so it is not taxable. Not like that. One third of 15,000 is only 5,000. Compare that with deduction amount of 15,000 possible. Whichever is lower is only allowed as deduction. 5,000 allowed as deduction, which means 10,000 is taxable. Next, royalty received from publisher 42,700 and spent 2,700 rupees on the books, stationery, etc. Naturally, expenditure genuinely is always allowed as deduction. Remaining 40,000 becomes taxable under income from other sources only. That is royalty from publishers or something like that. Then winnings from lotteries gross, that is 90,000. Gross we don't have to gross it up, already it is grossed, that is 90,000. But winnings from horse races net 35,000. See, net 35,000 means after TDS. So what is the formula there? Whatever received into 100 by 70. That means how much gross amount would have been earned? 50,000. Received is 35. Earned is not 35. Earned is 50. So 35,000 into 100 by 70. That is grossing up of casual income. We have to apply that provision. Dividend received from foreign company is taxable, sir. Dividend received from domestic company only is exempt under 1034. From foreign company, it is taxable. So 18,000 becomes taxable. So what is the total of income from other sources here? Add up all of them. Then we get total of income from other sources is 2,08,000. Only that is asked. You don't have to think about anything else. What is asked, that is enough. 2,08,000 rupees is the income from other sources of Mrs. Sarita for the assessment year 2021. Done. That was exercise number 10. Now moving on to exercise number 11. Once again here it is discuss. Discuss means only just to tell taxable or not taxable. Something like that. Let us see. Point number 1. A received an advance of 50,000 rupees on 1/9/2019 against the sale of his house. However, due to non-payment of installment in time, the contract cancelled and entire amount was forfeited. Of course, it is taxable as income from other sources in the hands of Mr. A. That's it. Because it is the amount of advance forfeited during the previous year, that will be taxable in the hands of recipient under income from other sources. Next. At this point, let me draw attention. Some people have this obsession on the numbers of 50,000. They apply that 50,000 everywhere. No, sir. That 50,000 is not everywhere. It is only for gift. This is completely different provision, different income. Don't apply that 50,000 wherever you see income from other sources. No. Income from other sources is a broader head. Within that, gift is only one provision. Within that, 50,000 is one threshold. So that cannot be applied everywhere. So this is taxable irrespective of the amount if an amount is forfeited during the previous year. Yes. Point number 1, taxable under income from other sources. Point number 2, different SASI. N is a member of his father's HUF, transferred house property to the HUF without consideration. Value of the house is 10 lakhs rupees as per the registrar. Nothing is taxable because he is a member of the HUF. So is a family member. That means he is a relative according to the definition. Hence, gift received by HUF from the relative is not taxable. Third point, Kumar gifted a car. See, whenever we see a car, automatically nothing is taxable, whatever the reason may be, whether it is given to sister's son, nephew, whatever, for achieving good marks in CA final exam, whatever it is, fair market value, whatever it is, doesn't matter. All the information is useless. Car is not a property, hence it is not a taxable gift. That's all. Next, question number 12. Examine the transactions in the context of Income Tax Act. Let us look at first case. B transferred 500 shares of Reliance Industries Limited to Mrs. B Company Private Limited on 10/10/2019 for 3 lakhs rupees when the market price was 5 lakhs. Indexed cost of acquisition of shares for Mr. B was computed at 4,45,000, already computed. That means long-term capital gain can be computed. The transfer was not subjected to STT. Determine the income chargeable to the hands of Mr. B and also Mrs. B Company Private Limited. See, for the company, first of all, inadequate consideration will be taxable because this is a movable property. We are talking about private limited shares, companies shares. So that is Reliance Industries Limited is a movable property share that is given to another private limited company. But whatever the inadequacy is there in this, that is 2 lakhs. That will be definitely taxable in the hands of B Company Private Limited as a receiver of the gift for inadequate consideration. That is one side. Other side, for B, who is a transferor, capital gains will be attracted. How it will be attracted? Here we have to identify one point. Whenever there is a shares which are like movable property, like shares, then fair market value of those shares should be considered to be the full value of consideration if there is any shares which are transferred by any SASI. So this is a part of full value of consideration and discussion on how to consider the full value of consideration. Already we have 50C, particularly for immovable properties. I think 50CA or something was there for movable properties. For movable properties, stamp duty valuation was given under 50C, and for movable properties, any type of movable properties, their fair market value has to be taken as full value of consideration. That means 5 lakhs has to be taken as full value of consideration, not 3 lakhs. That means how much is taxable in the hands of Mr. B? 55,000 is taxable as what? Long-term capital gain. Why? Because 445,000 as given in the question was indexed cost of acquisition. So for company B Company Private Limited, 2 lakhs is taxable under income from other sources. For Mr. B, for 55,000 is taxable as long-term capital gain. That is the conclusion of first point. Second point, Mr. Charan is employed in a company with a taxable salary income of 5 lakhs. He received a cash gift of 1 lakh in Mahatma Charitable Trust registered under 12AA. So it is a gift received from trust for meeting medical expenses. Is the cash gift so received from the trust chargeable to tax in the hands of Mr. Charan? Answer is no, because that is also part of the exempted gifts list. Gift received from a trust, local authority or university, etc. will not be taxable. So it is a trust which is registered under 12AA, which means it is a proper trust. That means nothing is taxable in the hands of Mr. Charan, even if he receives that from that trust. So not taxable is the answer for second point of exercise 12. These are the various aspects with application of gift and other provisions in the income from other sources. Now let us move on to one more last provision that could be also applied in some of the exam questions. This provision, we don't need to know all the subsections, clauses and all, 56 to 7b, whatever. It is applicable to a company in which public are not substantially interested. In other words, only closely held companies we are talking, or private companies, let us say, for understanding purposes. Technically, we have to call them every time company in which public are not substantially interested. Practically, private companies, private limited companies, let us say. Definitely, they are the ones who will be given in the question, so that clarity is there. Then, conditions. When this applicability of this provision happens is, when shares are issued by this closely held company, of course, that is the company we are talking about, to a resident person. resident. So the private company, for our simple understanding, is issuing shares to whom? A resident person at a price which exceeds the fair value of that shares. In other words, shares are issued at premium. Shares have to be issued at premium, and also they are issued at a price which exceeds the fair value of such shares. Then whatever the amount of consideration that is received from the issue, to whatever extent it exceeds the fair market value, shall be chargeable to tax in the hands of the issuer company under the head of income from other sources. For example, if fair market value of the shares of a private company is 100 rupees, but if the company issues the shares at 120 rupees, then that excess amount only will be taxable. That 20 rupees per share, whatever it received, that becomes taxable. What is the variety in that? It is complete variety. Why? Because when securities premium is there, it is not even a revenue receipt, it is a capital receipt. Normally, capital receipts should not be taxable under the basic principles of income tax. This is a violation of that, but still, they wanted to have curb on this type of practices on the private companies particularly. Like we discussed earlier, it's always it is possible for the private companies or closely held companies to resort to malpractices, like issuing shares at a very higher price and showing them as if they are capital receipts. But actually the receipts might not be capital receipts. Just for understanding purposes, if this provision is not there, what might happen? Say one private company is there which has received some consultancy services from one of the consultants, and they are supposed to pay 20 lakhs rupees to the consultant. Normally they are supposed to pay that, or they are supposed to receive some money for the services what they have rendered to somebody else, like that. So when they receive the money, it will be shown as PGBP and it will be taxable. If they want to avoid this, what they might do is they might just issue one share with a face value of 10 rupees with a securities premium of 19,90,990, like that. I mean, legally, is there any bar on that from Companies Act point of view? No. But if they do that, but is it really the case? That much securities premium will be there. Even it is more than the fair value of that company. So that excess of fair value of that company's share is deemed to be something wrong. Deemed to be. Of course, law will not tell all that. It only says, don't worry, you do whatever you want to do. But if you issue the shares at premium at a price which is more than the fair value of those shares, then the excess of the amount over and above the fair value of the shares, fair value, not face value, fair value of the shares, shall become taxable in the hands of the issuer company as income from other sources. Of course, there are some exceptions to this. If the shares are issued by venture capital undertaking, or if they are issued by companies notified by the central government keeps their power with them. If they notify that this provision is not applicable to some private company, according to their whims and fancies, naturally, whatever the kith and kin of their private companies are there, maybe they can say, no, this provision is not applicable to them, then it is not applicable. If the central government says, this class or this classes of person are not going to be having this provision, then they will not have it. That is the power they keep with them. But otherwise, normally, if any private company issues shares more than its fair value, and also its face value, when it is issuing shares at more than face value, that is premium. When it is issuing shares at more than fair value, which is more than already face value, because anyway shares cannot be issued at discount nowadays. So that amount in excess of the fair value of the shares will be taxable in the hands of the issuer as income from other sources. Very, very crucial point for particularly MCQ type of questions. Look at this exercise number 13 to apply the same provision. Discuss the tax implications in the following cases. Look at the point here. First of all, A private limited is there. Private limited, number of shares 10,000, face value 100 rupees, fair market value 120, issue price is 130. So issue price is more than fair market value. How much? 10 rupee per share, which means 10,000 into 10 rupees per share. 1 lakh rupees will be taxable in the hands of A private limited. That is the answer for this question. How much will be taxable? 1 lakh rupees will be taxable. Why? 10,000 into 10. What is the 10? Difference between issue price and fair market value. B Private Limited, 20,000 shares issued, face value 100, fair market value 110, 120, issue price is 110, nothing is taxable. What's the problem in that? Issue price is less than fair market value, no? There is no problem. So nothing is taxable for B Private Limited. C Private Limited, 30,000 shares, face value 100, fair market value 90, issue price is 98. See, first of all, this possibility itself is not there. This was old scenario. Why? Because earlier the shares were possible to be issued at discount. Now in Companies Act 2013 that has been changed. Shares cannot be issued at discount at all. Even then, let us say as an imagination also, nothing is taxable here under income from other sources, because first of all the shares here have to be issued at premium. Then only this provision will apply. Otherwise it will not apply at all. So if the shares are issued at discount, nothing is taxable. This provision will not apply at all. So that is the case of C Private Limited. D Private Limited, face value 100 rupees, fair market value 90 rupees, issue price is 110 rupees. So shares are issued at premium, but issue price is more than fair market value by 20. That means 20 into 40,000, 8 lakhs rupees will become taxable in the hands of D Private Limited. Difference between issue price and fair market value, 20 into 80,000, 8 lakhs. Because shares are issued at premium and issue price is more than fair market value. That's it. Then E Limited, first of all, this provision is not applicable, because limited means we have to assume that it is not a company in which public are it's a company in which public are substantially interested. It is a company where this provision is not applicable, assuming it is listed company. Of course, by the way, that is the reason I always tell, limited does not make it a company in which public are substantially interested. But private limited definitely makes a company that is a company in which public are not substantially interested. So that is why private limited is not something that we can really look at. We have to look at the facts of the case. Of course, the facts will be clear, which indicate us that whether this provision is applicable or not. For a closely held company, this word you can use, or you can use the word company in which public are not substantially interested. For them only this provision is applicable when the shares are issued at a premium, and that too at a price which is higher than the fair market value. Then the excess amount over and above the fair market value shall be taxable in the hands of the issuer company. That's it. That was question number 13, exercise number 13 we can say. Now, exercise number 14. This is a past examination question, exactly the type of questions that can be expected in the examination. From the following particulars of Pankaj for the previous year ended 31st March 2020, compute the income from the head, income from other sources. Taxable or not taxable, all that we need to identify. Let us just highlight them so that we can understand it is taxable or not. If yes, how much, also we can calculate. Director fees from company, yes, it is taxable. Under income from other sources, only we have to calculate income from other sources. Even if it is taxable under other heads, we don't care. So if it is income from other sources, then only we have to include it here. Director fees, yes, sitting fees is taxable under this head. Interest on bank deposits, definitely taxable. Income from undisclosed sources, definitely taxable under this head only. Winnings from lotteries, net 35,000. See, when it is net 35,000, how much will become taxable? Gross it up. Gross will be 50,000. So 50,000 becomes taxable here. 35,000 into 100 by 70. Next. Royalty on a book written by him is 9,000, and also he is mentioning here 1,000 rupees were paid for typing the manuscript of the book written by him, that is expenditure, which means how much will be taxable? 8,000 rupees. 9,000 minus 1,000 expenses. So 8,000 is taxable from that. Lectures in seminars, yes, taxable. These are all taxable. 50,000, 8,000 is taxable from this. These two are not taxable. Amount are different. So 5,000 is taxable. Lectures in seminars, no problem. Interest on loan given to a relative is taxable. Relative, I will say not taxable. No, relative gift provision is different. We are talking about interest received on a loan that we gave to our relative. That is the income, right? Definitely it is taxable. Interest on debentures of a company listed in a recognized stock exchange, net of taxes. So ideally we should know TDS rates here. See, no need to know now itself, but after the completion of TDS chapter, we will come to know. But in general, if nothing is mentioned, normally TDS is 10%. For casual income, it is 30%. For other incomes, it is 10%. In general, there are so many other rates, but in general, 10%. So 3,600, if it is net of taxes, how much would be the gross? So 3,600 into 100 by 90. that comes to 4,000. So 4,000 would be the gross income. Interest on post office savings bank account is exempt from tax up to 3,500 rupees. That is there in the section 10 subsection 15. So that also is another point to be noted. Up to 3,500 rupees for a single account or 7,000 rupees for a joint account. Post office savings bank account interest is exempt. This is exemption, not deduction. Exemption is different, deduction is different. Exempt means it will not even be just calculated, it will be just ignored. Interest on government securities is taxable, naturally normal taxable. Interest on monthly income scheme is also taxable. All the other things are taxable. So what is the final total income of this income from other sources of Mr. Pankaj? 10,000 plus, 3,000 plus, 12,000 plus, 50 plus 8,000 plus 5,000 plus 7,000 plus 4,000 plus 2,200 plus 33,000. Total 1,34,200 is the final answer for this question. 134,200. That's it. That is how past examination questions were asked from this head of income. Now moving on to the last question of this chapter, that is exercise number 15. Following details have been furnished by Mrs. Hemali pertaining to the year ended 31st March 2020. First point, cash gift of 51,000 rupees received from her friend, definitely taxable. But on what occasion? On her Shashtipta Purti, a wedding function celebrated on her husband's completing 6 years of age. This was also her 25th wedding anniversary. All that story we don't care. It is not marriage. It is not marriage, as simple as that. Wedding functions, wedding anniversaries are not marriages. So it will be taxable. Entire amount of 51,000. Yes. That is the first point. Second point. On the above occasion, diamond necklace worth 2 lakhs was presented by her sister. Sister not taxable. Because sister is relative. Since she received it from the sister, nothing is taxable. 2 lakhs, 2 crores, doesn't matter. Nothing is taxable if the gift is received from a relative. Then third point, when she celebrated her daughter's wedding on 21st February 2020, her friend assigned in Hemali's favor a fixed deposit by the said friend in a scheduled bank. Value of the fixed deposit and the accrued interest on that date was 51,000. So there are little, I would say, contradictory opinions on this. Some people say fixed deposit is not a property, hence it is not taxable. But that will be ridiculous. Why? Because it is a very, very clear money equivalent. We cannot say it is not a property. So I would say definitely it is a money equivalent. It is also taxable. So it is also as good as cash gift. Just because it is a fixed deposit, it does not make it any different from money. So it can be considered as property. It is as good as cash gift. So entire amount 51,000 is taxable. So naturally the total amount taxable under income from other sources in the hands of Mrs. Hemali is 1,02,000. That's it. These are the various provisions and application of the provisions under the head of income from other sources. With that, we'll conclude the chapter of income from other sources. Not only that, we can conclude the entire discussion on all the heads of incomes. So the main course of this syllabus is also completed. The starter of this course was related to definitions, basic concepts, terminology, computation of tax liability, that is rates of tax, and residential status. That was the starter part. That will have easily somewhere between 5 to 10 marks in the main exam. And now the heads of incomes is the main course. That is the core and crux of this paper. Salaries, income from house property, PGBP, capital gains, income from other sources. This will give at least 40 to 45 marks in the main exam out of 60. So that will be the crux of this entire paper. So we have completed the starter part and the main course part. The remaining things are the dessert part, which we will discuss in the upcoming classes. But till then, take care. Bye-bye. Thank you very much.